Good afternoon, ladies and gentlemen. Welcome back to yet another video. This is Blue League Markets, and today we're moving on with our lessons. We're going to focus on a very important thing, which is what we call swing high and swing lows. In the forex market, you need to understand the stages the market presents itself in order to understand whether now you moving on with your break of structure or you still within internal structure. In the next video, I'll be explaining internal structure and external structure so that you can understand that sometimes you'll be working with a small portion of the market while focusing on the big proportion of the market. So you need to understand what we call multi-time frame analysis. But all of that are going to be explained on the advanced smart money course. Now, in this video, I just want to make a quick short video explaining the swing high and swing low, the sell zone, the equilibrium, and the buy zone, right? Let's say, for instance, we on an uptrend. So the market is moving in this direction, and it's having an uptrend. Um, it's having an uptrend, right? Let's say the market is breaking structure. Now remember, I'll keep emphasizing this. Before the market breaks structure, it will leave you with an inducement, it will leave you with an order block, it will leave you with a point of interest, and it will leave you with liquidity, right? So after the market has broken structure, you go check the lowest point the market presented before it broke structure. In this case, we will denote it with a red dot. Now, from now on, just know that whenever you see a red dot on my chart, we're denoting a swing low, right? And just know that whenever we have a green dot on our chart, that's denoting a swing high, right? So now you check the lowest the market has went before it broke structure. In this case, this is the lowest the market has went before going up and breaking that structure, right? So there will be other price action here. Now, how do you denote a swing high? A swing high, you denote it as the highest the market has went before it started having a pullback. Now, what's a pullback? Now, remember that the market cannot go in a linear form. It cannot continue having an uptrend. It should have an uptrend. It should adjust itself, come take orders, take stop losses, collect money, then continue going up. So that's what we call a pullback, right? So the highest point the market presented or printed before having a pullback, that's your swing high. Now, how can you validate your swing high? You validate your swing high when the market has came and it has broken the first inducement. So this is your first inducement. So there might be other inducements here created, but the minute the market breaks the first inducement, and that inducement is a valid inducement, just know that this swing high is now validated. Then you can put a dot there to say, you know what, the next time the market comes to that point and breaks it, then you have a valid break of structure. Because what I've seen people do is they will have a lot of break of structures. By that time, the market has not even broken an inducement. It's just playing around here, acting as if it's breaking structures. And that has gotten a people frustrated because now they'll think that smart money doesn't work, but in reality they denoting wrong swing highs, they denoting wrong swing lows, right? For now, I just want you to understand that when a swing low firstly is validated, the market has to come break structure. Immediately the market breaks structure, meaning it breaks the previous swing high, then you can say no, the swing low, it's right. But don't denote it first, because the market might turn around here and go back and break that point you said it's your swing low. Immediately it breaks that swing low. That swing low, it's no longer a swing low. You're going to wait for the market to print another swing low until the last swing low it prints before breaking structure. I know I'm saying a lot of things for now. I know it doesn't make sense. I will explain this better using the charts, right? The chart. So immediately the market is breaking your inducement, then continues going up, then it breaks your structure. What do we have now? Now we have a new swing low. So this point becomes our new swing low. If you can understand how the market works like this, then you'll understand the steps the market takes in order to progress to the next stage. Whenever the market maybe returns from here, let's say it goes down and it comes and breaks this swing low, then you have what we call a change of structure, because the market didn't continue with the usual pattern of breaking a swing low, breaking a swing high, a swing low, breaking a swing high, having an uptrend like that. Immediately it breaks a swing low, a swing high breaks a swing low. Just know that now the market is shifting to what we call a downtrend. It's having a market shift, it's having a flip. Some people call it a flip, right? So just know that we have a chop there. But I'll explain this better in the next video. So here I've written stages of the market. So as you can see that in between a swing high and a swing low, you need to have a sell zone, you need to understand your buy zone, and you need to understand your equilibrium. That's where the market balances itself. As long as the market has not went below this equilibrium or above it, just know that it hasn't had a proper 100% pullback. The minute the market comes, let's say it's having an uptrend, then it breaks your equilibrium, it goes down, and it mitigates something, or it touches an order block, then it goes up. Just know that's a perfect pullback. That's what we want to see. We want to see the market having a proper pullback. Without the market doing that, we're not having a proper pullback. Now let's repeat all this having in terms of a downtrend. Let's say the market is having a downtrend. It's coming like this. This is your inducement, right? Okay, let me put this here. Let's say the market is having a downtrend, right? So firstly, it will have a break of structure. Let's say it had a break of structure. Let's say it had a break of structure here. So this will be our break of structure to the downwards. Now, since it had a break of structure there, what would be our inducement? This will be our inducement, right? This will be our first inducement. Now, what are we going to wait for? We're going to wait for the market to to break that inducement, come and mitigate an order block somewhere there. We'll have a high probability order block there. Then afterwards, we'll take our will denote our swing high at this point. So at this point, this is our swing high because it's the last point before the market broke structure, right? So it's our last point before the market broke structure here. So how do we check our swing low? Now our swing low, it's supposed to be the last point before the market broke inducement. So at this point, this is a swing low which is not protected. It's not guaranteed. So we'll say that's our unprotected swing low. Then we let the market play out. Let's say the market play out. Let's say it does something like this. Okay, let's say the market plays out and it does something like this. It starts playing around. Now remember, when the market is playing around, don't get frustrated. It's doing what we call liquidity. It's collecting money. Let's say it breaks that point. Now someone might ask me, so what's our swing low now? That unprotected swing low has been broken, so we delete it. It's no longer our swing low. We're going to wait for the market to break our inducement. Let's say the market then collects whatever it wanted to collect. It continues doing that. Now, a lot of people, remember, if you denoted your swing low wrong, let's say you said this is your swing low and it was your correct swing low, and you forgot that the market has to come and break inducement. Remember, what you were going to do after that, you were going to say this is your break of structure. That's the mistakes people do, and they'll say this is their break of structure. Well, that's not a break of structure, because remember now, that break of structure is happened when the market was not protected. Let me just go back to where I was. Now, this is what we call smart money trap. They trapping smart money traders to thinking that the market has now broken structure. Well, the market has not broken structure. So remember, if you say that break of structure, what are you going to be looking for? You're going to be looking for buys here. Sells, I mean, here. You're going to hope the market does this and then it comes and breaks them. Then you forget the bigger picture. What's the bigger picture? The bigger picture is that the market left orders there. It has orders there which were not mitigated. Here it was just pretending to be breaking structure so that it catches smart money traders, right? So let me delete that. So that's not really a break of structure. That's what we call smart money trap. So this swing low, it's wrong. So we're going to wait for the market to break an inducement. And remember that our inducement has to be within our 50% zone. Since the market has now done this, it has created an inducement again. Now, how do we check that? It has created another inducement. This is also an inducement, and in fact, it's also in liquidity, right? So now we have two inducements, right? And we have the lowest point, here. So how do we check when the market is now moving like this? Now want to check which inducement is correct. Where do we expect the market? Because now if it breaks it, yes, it has broken an inducement and goes down. Are we correct to say that now this is our swing low, and when the market breaks it, we're now having a break of structure? We can only confirm that using one thing. We use our fib retracement. We take it from that swing high we did to our swing low. As you can see, guys, that the market did not, this inducement was not above our 50% zone, so we cannot say that inducement is valid. So this is what we call a smart money trap again. It's the market making us believe that it has broken inducement, while in true reality it has not. So that becomes a fake inducement, right? So we're going to wait for the market to come and break our 50% zone. So if the market did something like this, it broke above the 50% zone, then it also broke our inducement. Then we have every right to say, look, now we have our swing low. It's a protected swing low, right? If it has done something like this, then we more than welcome to say, you know what, the market has to come collect orders um, on uh, our order block. So we more than welcome to have extremely um, we more than welcome to say, look, the market has to come mitigate that, right? So we can take high probability trades there. Because it has broken our inducement, it's on a 50% zone, then we can say that the swing low is protected. We actually take profit there. So the market, what it will do, it will then come create some sort of liquidity. I'll explain type of liquidities in the next videos. Then it will mitigate them and it will continue going down. So this concept of swing high, swing low, it's very important. People don't really understand it that much. I'll keep explaining it using charts until you understand it, because this is a very important lesson. You need to understand the stages in your trading. With all that being said, I'd like to thank you for watching the video. Please don't forget to like, subscribe, and comment. See you on the next one. Bye. Blue League signing out.